Good afternoon, all. Hope you had a great session so far. There was an action packed agenda earlier, primarily on the cybersecurity part and social engineering, along with the compliance challenges. And the last session that we had was primarily on the SAP financial compliance management. Uh, this session that we have is on the fundamentals of effective risk and controls. I'm Asima Ahuja. I am managing consultant. And I'm joined by Julianne Megri, a very special guest from Birmingham University. And she would be sharing a lot of her experiences on risk and control consideration. Great. Julianne, would you be, if you want to quickly introduce yourself today?
So, hi everybody out there in the ether. I'm Julianne McGarry. I'm a senior lecturer at Birmingham City University. I have over 30 years experience in audit, risk and controls. I've worked in sectors from financial services to multinationals and US listed businesses, including I've also worked in the public sector. So hopefully today I'll bring some breadth of experience, but what I want to do is go back to some of the fundamentals about risk and control for you. Back to you, Asim. So shall I take over now?
Yeah, please, Julianne.
Right, okay. So today's session is the 10 fundamentals of effective risk and control. So what we're going to look at is we're going to look at briefly what do management actually know about risk and how to manage risk, because I think this is an area that's quite lacking, and it is an area where risk, audit and control professionals need to step in and help them and look at actually what does appetite mean. Lots of people talk about what is your appetite for risk. So if you are a skydiver, you're going to have a larger appetite for risk than somebody who only actually wants to go for a country walk on flat land in Lincolnshire in the UK, or in not going up the Rocky Mountains in Colorado. We're going to discuss some of the rules about control and design considerations, because as I've gone from sector to sector and industry to industry, I've seen controls that are very well documented, and I've seen some really poorly documented controls. And also, I think as an ex-audit professional and now training the next generation of internal auditors, I think internal audit could do more in looking at the design considerations of controls and ensuring that the 10 design principles are covered. So, Asim, please, can I have the next slide? I think we've got a bit of a time delay here. Thank you. So these are the 10 design principles. If control and audit professionals can learn this and can articulate it to management, the internal control frameworks within organizations will become clearer, they will become better documented, and they are easier to audit. So we're going to start with risk, because if you don't have risk, you don't need a control, because control is there to manage risk. So lots of organizations just start with process flows, identifying the controls within the process. But what they should be doing is saying, what is the risk we want to manage? Next slide, please, Asim. So as the slides move forward, let's look at the definition of risk. So the top line is really, what is the textbook definition? So it is the possibility of an event occurring that will have an impact on the achievement of objectives. Risk is measured in terms of impact and likelihood. So most people these days understand those concepts, but what we've done is we've refined the definitions, because an impact doesn't have to be downside. It can also be upside. So simply, it's the effect of uncertainties on objectives. So your risk should link to your strategic objectives, your corporate objectives, the objective of the process being there. What is its reason for being? Not that this is a risk for payments. Why is it a risk for payments? If you can articulate the risk in a well-rounded fashion, then yes, you've got a good risk. So the quality of the risk documentation is fundamental before you do anything else with regards to controls. So please, can I have the next slide, Asim? So the next question I pose is, how do management know what risks to manage? Now, when I moved into the world of academia, and obviously I teach risk, I thought, well, let's actually have a look at what training there is for risk. So we have lots and lots of students that go through university, they get their degrees, they go into industry as graduate trainees. Some of them are on accelerated progression paths because they're seen as the strategic leaders of the future. So I looked at legal courses, I've looked at HR, I've looked at marketing, I've looked at IT, and very, very few, or if any, have any modules that look at how do you identify risk and how do you manage risk. So we have all of these people coming into industry. They're all moving up through industry or public sector. And then as an audit professional, we come along and we audit them and we say, you're not managing your risks. So if we've not trained them on what risk is in the first place, how can we manage them? And I see the risk, the controls, and the audit professionals, so our GRC landscape people, as the people to go out there and educate. What do you mean by risk? And going back to that definition about it's managing uncertainty of objectives, because my risk and my lens of the world is very different to Asim's. Asim might be a risk taker and he's out skydiving every weekend. I like to sit at home, walk my dogs and crochet. So I'm more risk adverse. I like certainty and I like structure and frameworks. Not everybody does. And until we get our senior leaders and our managers to identify that, there is a risk that we are focusing on process and not the things that matter. We are in a world of scarce resources in people, time, and money, and we need to devote that to those areas of greatest concern. What's going to keep me awake at night? So moving on to the fundamental concepts of risk. It requires putting the organization's assets and resources at some degree of risk. Because if you don't take a risk, you're not going to make a product. You're not going to get a return. You're not going to be able to invest in financial markets. Everything in life, even walking out of your front door in the morning, you are accepting some degree of risk. And it should be commensurate with the potential reward that you're going to get. So if we look at the likes of Tesla, that was big risk taking at the start, and they're reaping the rewards. There's another organization called unravel that make electric vans. They've taken a different concept to the way that they manage their risk, in the fact that they're using micro factories instead of gigafactories. They've taken a different approach to manage their risk because they have a different appetite. And the other thing that tends to really bother me and keep me awake at night is that people think that reviewing our risk assessment and our risk register is an annual thing. It is not. The world changes on an axis very quickly. For those of you who are based in the UK, potentially in the financial services market, your risk universe has changed in the last 3 weeks dramatically. If you are in the US, your risk appetite will change depending on your political leaders or things that happen within the country. So we have to constantly have risk as part of our conversation. Management should be continually, regularly reviewing their risk registers. What's happening in the world that impacts us, because we cannot be insular. SWOT analysis is no longer a thing on its own. You have to do a PESTLE first. You have to understand the world in which you operate before you can actually determine where you want to be. And risk needs to reduce the likelihood of the negative outcome and increase the likelihood of the positive outcome. So if you could move on to the next slide. So when we look at what is our risk appetite, we've said it's about investing. You know, we have the generic level of uncertainty. We have the amount of risk that the board wants to take and is willing to accept. And then the type of risk the organisation is prepared to pursue to take that advantage. And in here, I've got some references. So COSO, so I'm hoping that lots of people know about the Committee of Sponsoring Organisations of the Treadway Commission, which is the Canadian board that set up the COSO framework. It is a globally recognised standard. The COSO ERM model is, I can't say how good it is in getting management to accept. So if you don't have a formalised risk management framework, go and invest in looking at COSO ERM, and you should do ERM, which is your enterprise risk management, before you look at the internal controls part. Because as I said at the top of the session, risk comes first, control is subservient to risk. So I hope that's helpful for people. And if you are in an organization that is wanting to pursue risk, the ISO 31000 series really can help you in understanding some of those definitions. So we all accept that we have TARA, which is either transfer, avoid, reduce, and accept risk. And now we want to pursue risk as well. Otherwise, we stand still or we become irrelevant and we move backwards. And I can cite some historic UK brands where that happened. So that's what I wanted to cover on risk. And I'm sure some of you hopefully will have some questions, which we will cover at the end and come back to this. So if we move on to now, so we've said, what is risk? What is a control? And this is a slide I give my students because I have many trainee auditors that come to me and I say to them, okay, what is a control? And they struggle to come up with a single sentence definition. This is the definition I teach them. It is an action. If it is not an action, it is not a control. Your policies and procedures are not effective controls because they don't make something happen or they don't stop something happening. Your best controls, for those of you from the IT world will know, are your preventative controls, your system-derived controls, and I believe the last session was looking at SAP, and was looking at some automated controls. And then you get automated controls monitoring. Preventative, fantastic. Only cost effective if you put them in when you deploy a system. Otherwise, you've got the detective controls, which are after the fact and therefore more costly for things to be put right. A directive control is, and I tell my students this, is like the highway code. Yes, it gives you the guidance, it gives you the direction, but it does not stop you speeding. It does not stop you breaking the law. All you have is detective controls that catch you. The speed camera, the road bumps. You could say those are preventative because they're trying to get you to slow down. But it has to be an action, either by people taking action, usually detective afterwards, preventative, system driven. It has to happen on a repeatable basis to manage risk. If you are not repeating it, it is a risk mitigation action. For it to be classed as a control, it has to be something that you do over and over again. So every time you go to sign into your commuter, there's an automated control that's asking for your password. If you don't give the right one, you can't get in. Yeah. If you're taking out insurance policies, yes, that is a mitigating action. It is a control because it's on a repeatable basis to reduce risk. But it must increase the likelihood that goals and objectives will be met. So if you take the third point into consideration, insurance fails to meet that objective because it doesn't stop the thing that you want to insure against happening. It only reduces the impact because you get a financial payout. So hopefully that's clear. Please, if the slides become available to you, save this. It is the easiest way of remembering what is a control. You have to meet all three criteria for it to fall into that category. But then I go one step further with the students. If we can move on to the next slide, please, Asim. There are 5 rules. So we have a definition. We've now got 5 rules. It must have a purpose. If it doesn't have a purpose to make something stop or happen, it's not a control. I've already stated, if it is not there to manage risk, it's not a control. It must have a trigger, being time or event. That's where the repeatability comes in. It must be able to be executed in the same way each time it is performed. That is when we move on to the next slide, but we're not going there yet, see. It's the other 9 principles. And it cannot be a policy or a procedure. I can be given it, I can put it in my drawer, and I can ignore it. However, that said, if you are required to attest that you have read the policy and procedure and you acknowledge and understand it, so all our organisations, I hope, have a code of conduct policy that every so often we have to read or do a training, and we sign something or we do a digital signature to say, yes, we have read this and we understand it. That is the control. The control is you've had to attest that you read and you understand, not the fact that you have a policy. And that's where a lot of organizations fall foul, because they go, yes, we're in control. We've got policies and procedures. Nobody goes onto the intranet. People don't know when to find them. They're not updated. They're not regularly reviewed. And I've seen policies that are 10 years out of date and irrelevant to the organization as it stands at that point in time. So 5 rules, easily remembered. Now we'll get into the meat. So if we move to the next slide, Asim, I'm now going to cover the other 9 principles. So we've already alluded to objective. When you write your controls, you should be writing a control objective because that is its purpose for being. And I always when I used to train internal auditors, when I was out in the field, when I was working and not lecturing, which is a form of working, I would actually teach my trainees to every control objective to ensure that. Because if you can start your sentence to ensure that, you then naturally follow on to something will or will not happen. That's this objective and the acknowledgement of the risk in the objective. It cannot be the obverse of the risk, because that doesn't work, because you can have many controls for one risk and you can have many risks for one control. It's a multi to multi relationship. Yes. So once you've understood what your objective is and its purpose for being, you then need to know who owns it. Now, I've gone into organizations and I've started looking at the controls for, pick something simple, balance sheet line item reconciliations. Really, really boring, really, really financial control. However, every person who is performing a balance sheet line item reconciliation thinks that they own it. They don't. They are control operators because they are doing what they've been told to do. You can only be a control owner if you can change the design of the control. So somebody in central finance, usually the technical accountant, will own the policy and the procedure for balance sheet line item reconciliations. They are the control owner and everybody else is an operator because they are operating within a framework. And lots of organizations fail to identify the difference between the owner and the operator. And if you work in a SOX world, which I was for many, many years, understanding that gives you clarity of when you have issues, because it is the owner who has to fix it. So you can't have multiple owners. You can only have one owner because they are accountable. Because there is a difference for responsibility is the operator, accountability is the owner. Once you've understood that, move on to your inputs and your frequencies. So your inputs is, where do I get my information from and how do I do it? So what is my trigger? So is my trigger, it's month end, finance? Is my trigger, a seam is trying to break into Julianne's computer? Yep. The frequency can be anything from continuous, because it's a continuous control of a seam's trying to break into my computer because it's a preventative control, or it could be an event trigger. So if I'm going to decide I'm going to go and buy a business, I'll have merger and acquisitions controls that will only trigger because I'm going to buy a business. You need to know the frequency. You need to know the trigger. Because if you don't, how can you determine whether it's operated with predictability and every time it needs to occur? So we've then got operation and predictability. So this is where you document what happens in the execution of the control. Everything, we hadn't even got to how the control is operated, and we're already up to 0.5. Now we document what the control is. And it has to be documented in such a way. So you can't just say, go and do a reconciliation. How do I need to do the reconciliation? What format does the reconciliation need to be in? Do I need to use a standard template? And it has to be documented that if I went sick and a scene was going to perform my controls, he could pick up the control description and know what he needs to do. And so many control descriptions are a single sentence. And I pick it up and I go, well, how do you know what to do? You can refer to another procedure. You can refer to a work instruction. But if you don't refer to it, how does the person know what to do? And this is where a lot of people fall down, is they don't give that level of detail. It's an absolute ball ache to do. It's really, really hard, but it has to be done. And as you're documenting it, you need to think about tolerances and estimations. So if I'm doing a warranty control, there is an estimation, because you don't know how many of your products are going to come back. You don't know how much money you need to put aside for it. So you do a financial calculation based on quantitative information from production, from history, qualitative information from forecasts from the future, and then you just go like that. But you document the calculation. Those estimations and tolerances have to be documented. So if you've got a three-way control within SAP and you have your purchase order, your goods receipt, and your invoice, you will have a tolerance built into a table embedded within the system. And that will say how many pennies or dollars or cents or volume it doesn't need to match to for it to match and go through for payment. That is your tolerance levels. They need to be known, but the owner needs to know it. So the payments manager needs to know what those are, not somebody sat in IT. It needs to be the owner. And that's where another thing, oh, that's IT. No, it's not. They own functionality. They own delivery. They are a facilitator for the running of the business. The owner of the control has to own this and has to know it. Then what happens with exceptions? Best story in the world. Process transferred to India. India were doing the process, but nobody ever told them what happens if something happened. So what was an exception? So they just sat there and they built up. And then UK complained about India that they weren't doing something. Go back to the controls and the processes. UK never told India what they had to do with the exception. Owner's responsibility, owner at fault, owner had to correct it. Not India's problem, UK's problem. Next thing is activation date. When did the control start operating from? That way. Because if you get audited and you've changed your control, the risk is your auditors are going to fail your controls because you've changed the way that they've operated during the course of the year. If you know the date that it changed and how it was performed beforehand, because you have very good version history, and how it operates now, you're going to pass the control. I know that I'm running out of time, so I really want to keep this up. Information source. Where does your information come from? So if you are using spreadsheets, are there spreadsheets control? So in the trade, we call that end user computing. Yes. Are they appropriately controlled? And I could give you a whole hour on spreadsheet controls, so I'm not doing that today. The other thing is in the trade, in the SOX world, we call it IPE, information produced by entity. What is the logic of the reports that you receive? What are the parameters that you receive? The number of times I have sat with management and they go, oh, well, I received the report and I do that. And I go, well, how do you know that report is complete and accurate? Because I get it from the system. If anybody knows anything about the Horizon system at the post office in the UK, and for those guys overseas, please, there's a really good documentary about it on Netflix, I believe. Look it up. It's the Great Post Office Scandal. There's a book about it. The information source was wrong. The data from the systems were wrong. A number of postmasters, so people who ran the post offices, went to jail. And it was the system that was at fault. Not the people, the system. You have to know where your information has come from, and you have to know about its integrity and its reliability. If you don't, your controls are not good. And then you need to know, lastly, what evidence that you need to keep. And the mantra I teach my students, the mantra that I've treated everybody who's ever worked for me is, if you cannot prove it, you didn't do it. Don't tell me you had a meeting. What were the actions from the meeting? Where are they documented? Don't just give me a signature. That doesn't prove that you've read the document. Where are your review notes? Yes, evidence is key. We live in a digital age We can do everything electronically. We can put data stamps on everything. You need to know the evidence. So please take away, if you can't prove it, you didn't do it. And I used to say that to my children, and that was a brilliant conversation. So my last slide, because I know that some of you have other things to be getting on and doing, is the control design considerations. Please don't boil the ocean. Back in 2002, when Sarbanes-Oxley came about, everybody boiled the ocean. Loads of organisations started delisting, and then they brought in AS5. Reflect the size and nature of your activities, which is why you go back to risk. If the risk is not important to the business, why are the controls? Why test them? Could you test them once a year? Yes, you need to have those conversations. Establish the formal lines of authority. Get a governance structure in place. Does the controls function report output to the audit committee? Because they get internal audit, they get external audit, but hey, the controls are quite fundamental. Include them. Define key areas of responsibility. Accountability, accountability, accountability. I can't say it enough. Your reporting lines. If you've got your internal controls function reporting to middle management, nobody cares about controls. Yeah, you've got to report to the top. You've got to have that governance structure. Establish relationships. You're not there as internal police. Talk to people, build relationships. If the best organizations I've been in is when they're going to do major system, process, program changes, and they come along and they say, internal controls function, please become part of this. So our controls get bedded in and we have those risk conversations. Diverse organizational tasks is not just about finance. US, internal controls over financial reporting. India, if you are listed in India, it's internal control environment. It's not finance, it's everything. Think about it. UK, yet to be determined. And allocate and deploy your resources accordingly. Go back to risk. High risks, do it. And the controls function should be reviewing the corporate risk register and the operational risks of the business and adjusting their controls and where they test accordingly. Life is fluid. We've learned very quickly this year, life turns on a sixpence and we have to be dynamic and agile and move with the times. So that is a blur from me. Back to you, Asim.
Thank you so much, Julian. That was a lot of great insights that all of us wanted to hear. And apart from that, there have been a few questions as well. And just going through the challenges many of our clients faced, and you've highlighted a number of them, is to have the right framework, have the right governance structure in place. Because at times, a number of clients wants to thinks that if they buy a GRC tool, all things are going to fall in place automatically. But
No.
it's having the right framework, having the right methodology, the way you assess the risk, and having that risk appetite tolerances defined, and business change, empowering people, making them accountable is the biggest challenge that I have seen major change initiatives fail. So definitely, those were the things we all wanted to hear about. And the few questions that we have today are: when managing risk from manual systems to processes, what are the challenges organizations face?
So if you're managing risk and you're moving from manual systems to automated processes, I presume it's automated. I find a lot of it is, it's really hard to get people to let go of what they do. It's like, I've always done that way. It's, for me, the whole thing about rolling it out, GRC systems and controls, is education. It's not about what you do, it's about the people. And you have to talk to the people, and they have to feel comfortable that things aren't going to go wrong. So I find that end user testing, wrong people, wrong time, back end, very, very restricted. Front end of moving from manual to automated, don't spend enough time talking to middle management because they're going to be the control owners. They're the guys that are going to be on the firing line if it all goes belly up. So getting them in and saying, well, this is what we're planning on doing because you're going to do it anyway, whether they like it or not. Seek their input. So we're going to want you, and I've rolled out a few GRC systems in my time now, and this is what we're going to do. Like it or lump it, it's going to happen. But we want your input. So if you've got your dashboard, what do you want to see? What's important to you? Get working groups, because if they feel they've got a stake in the game, they're going to play the game fairly. If they feel that they're ignored, they're going to ignore your system because you're not going to be in their face anymore. They're just going to be getting emails, which will go to a builder Outlook rule if you use Outlook, and it will just go into a folder and it will just get ignored. Because
Sure.
I do it for stuff that I don't want to see. It just goes in a bin folder and it never gets looked at. And then at the end of the year, nobody's chased me for anything, so I delete it. And then I start again. So, we have to understand the psyche of our business. You need to know your personalities, which is why, for me, internal controls is not a numbers game. It's a people game.
Sure.
Bring them with you. Give them that warm, fuzzy feeling that their opinions count, that they want to be included. Yes, it's going to take you longer. You just can't take this manual data from a spreadsheet, upload it into a system, and it's great, because you want accountability on the other end. Instead of chasing them for their actions, say, you can update your action at any time. I'll get a notification. You give me work because I've got to review what you've done. So
Right.
if they feel that they're taking control, they are more likely to play the game.
Right. Gr- Thanks, Julian. And very quickly, I know we're running a bit over time. There's another question that talks about acceptance of the risk framework by the external auditors.
Yes, so this is something that I spent years with arguing with external auditors over internal controls and wording and documentation. Everything that I teach and everything that I have shared with you, and I have used this framework in a couple of multinational businesses, everything is based from the PCAOB. So everybody in the US will get that term. Their auditing standard number 5, and then the subsequent standards about materiality, about testing and evidence. Because what happens is the PCAOB will audit external audit files, and then they will give guidance on when they can improve. So back in 2014, for example, the PCAOB did a whole load of reviews of various organisations and started pulling up the external auditors on information produced by entity, system generated reports to the normal people like us, and end user computing, so spreadsheets for the normal people like us, saying that they weren't asking those appropriate questions about integrity, reliability, completeness, and accuracy. All of that is actually based in auditing standard number 5. So what I did was I went back to basics, picked out everything. So for me, if you can apply the 10 design principles to your internal control framework, there isn't an external audit firm out there will find anything missing. And then you build your relationship with your external audit firm. And then apart from the key financial controls they have to do anyway for substantive testing for their financial audit, they will start doing some spot testing on your testing and start placing more reliance on your internal control framework. And ka-ching, you can start negotiating your audit fees down.
Great.
Ta-da!
And the last question that we have, Julian, thank you so much for this, is the role of KRIs and what are the benefits that KRIs have?
Key risk indicators. So what you should be able to do, and this is a nice to have, is that you should be able to map your control objectives and your control groups back to your key risk indicators. So absolutely, it's the way to go, because if you've got a good GRC system, and there's lots out there, and I'm sure Turnkey will talk to you about different GRC systems, you can actually create interactive dashboards that link your risk framework, so your enterprise risk management, which is where your key risk indicators come from, your internal controls framework, and your internal audit function, and their recommendations and output from that. So you actually give the C-suite one version of the truth. Because today, in a lot of organizations, even those that have GRC systems, they are separate universes and they are not a joined up Venn diagram.
Right.
And it's only when you get a joined up Venn diagram, you get the one version of truth in your triangle in the middle, and that is the sweet spot.
Yep.
Because when you can give the board one thing, everybody's talking the same language, but it requires all three functions to talk to each other, which they don't always do.
Certainly, Julian. That's the nirvana state that all organizations are definitely aiming for. And coming from experience that a lot of GRC implementations and advisory that we have done, risk, compliance, and audit, they need to share the same master data at times, and along with the same transactional data as well, so that all functions are up to date, what's happening within other. And risk assessor, they should get the most updated information based on the key risk indicators that can tap various system of records and show you how risk or controls have changed over time. Great.
Absolutely. If you can get the one universe, say internal audit is the third line of defense, they do have their independence and objectivity, which has to be protected, but they could share their universe. You all talk the same language, but their detailed files and supporting documentation has to remain confidential, because that is the nature of their job.
Great.
Anyway,
thank you so much, Julian. This was
you're welcome.
Very insightful session that we had. And for day 2 tomorrow, we got a number of sessions listed for all of you, starting with Power of Community from Tata Steel and UKSUG. We got SailPoint, Beyond Trust, talking to you about identity-centric zero trust. And then we have SGP, Carlsberg, BP, and Range Consulting to touch some of the aspects that we have discussed today. And I believe Range Consulting would be talking about business change that Julian also mentioned is critical to cultivate that risk culture, and so that people own up that risk, own up that control, and start to work together as 3 lines of defense model, the way it was designed to be. That's all we have for today. If you have any other questions, drop a note to me, Asim Ahuja at turnkeyconsulting.com. And Julian, thank you so much for sharing all the insights and experiences with us.
You're welcome.
Cheers. Thank you. Thanks all.